come along the way, but and Frank's recording already, so maybe I should go ahead and get us underway. I'd like to welcome you all to our webinar, Seventh Generation Interfaith Coalition for Responsible Investments webinar on positive screens, going beyond the negative. Frank, if you'll advance the slide. Everyone will begin in listen-only mode until the question and answer section, and we will make the recording and the slides available, and it'll be posted on our website. And also after this, we'll send out an evaluation because we'd really appreciate your feedback. In terms of reflection, just as a starting point, good goods. I found this writing. It reads, successful businesses identify and seek to address genuine human needs and a superior level of excellence using a great deal of innovation, creativity, and initiative. They produce what has been produced before, but often, as in the arenas of medicine, communication, credit, food production, energy, and welfare provision, they invent entirely new ways of meeting human needs. And they incrementally improve their products and services, which, where they are genuinely good, improve the quality of people's lives. It's a simple text that talks about the uplifting nature in a certain way of a well-run business. And the question I'd ask you to ask before we pass ahead, who do you think wrote this? Or where do you think this was found? Would you imagine this was found in a business school text? Perhaps the language isn't quite right for, say, the father of capitalism, Adam Smith. But in fact, Frank, if you'll click. This is from a Vatican document. Cardinal Turkson supervised the writing of this document on the vocation of the business leader. And it speaks, I think, in a certain way as well to the topic we're taking on today, looking at positive screens, trying to select things that are both good for people and planet and good as well for one's portfolio. So Frank, if you'll move us another. We have two companions with us today. We have John Mueller of Dana Investment Advisors, and we have Ariane du Vienne of Institutional Shareholder Services. And what we're going to visit today is really a handful of portions here. Evolution of ESG investment strategies, COVID-19 and racial justice impacts, the use of positive selection criteria. We'll have question and answers along the way, and we'll point you towards some additional resources. And we can advance one more. This portion will be led by our good friend and SGI member, John Mueller. John is an SGI member from Dana Investment Advisors. It's probably the shortest bio I've given anyone, but that was at his request. Oh, John, we need to take you off mute, I think.
Perfect. There we go. All right, well, good morning, everyone, and thank you for joining us today. You know, the idea for this presentation came out of conversations from last year's gathering in October that we did at Marquette. In some of the larger and smaller conversations, I was surprised to find out that many of our members seemed to still only be familiar with negative or exclusionary screening. I'm excited for today's presentation, and I hope that you will find it informative and helpful in your greater underlying missions that all of you have at efforts. I'm going to run through a brief history of ESG and some of the investment implementations, and then a short example. And then my partner in today's presentation, Ariane, is going to handle all the really good stuff. So Frank, if you could go next. This is just a disclosure for the sake of disclosures and pleasing the attorneys. So as you all know, you know, you've been involved in sustainable or responsible investing for many years, yet I thought it would be helpful for providing a quick refresher. And so here's a brief timeline of sort of ESG investing. Many credit the Pioneer Fund in 1928 as the first responsible investing fund. And at the time, it definitely would have qualified on an exclusionary value-based themes. However, the 70s started a whole new type of revolution with the US involvement in the Vietnam War and chemical weapons. Shareholders began to organize and propel practices for sustainable investing. While the anti-apartheid movement started on many college campuses in the 1960s, it wasn't until 1977 with Reverend Sullivan's Code of Conduct was released. And it took nearly 10 years later that US companies started cutting ties with South Africa in 1985. So in the 70s, we also had our founding of ICCR, which is near and dear to many of us on this call. The 80s ushered in an era of legislation for corporate responsibility as shareholder activism pressured corporate behavior. Environmental concerns continued to rise to sustainable investing, and that really gave way in 1989 with the oil spill from the Exxon Valdez, put the spotlight on fossil fuel companies. Also at that point in time, Ceres, another organization that many of us are familiar with, was originated. The 90s continued to focus on environmental concerns with the awareness of a warming planet. We got our first look at a sustainable index with the inception of the Domini 400 and the early start of positive screening criteria on governance practices. The 2000s introduced a more holistic approach, and the term ESG investing was sort of introduced. The United Nations launches PRI, which it's amazing that it took nearly 15 to 20 years for that to really resonate with the investment community, it seems. And the efforts to create more of an impact on society were also prevalent in the 2000s, and more impact investing came forth. Our last decade could be kind of defined as more of a decade of action. Consumers started to be more aware of purchasing decisions on sustainability. Public pension plans took notice of ESG principles, and sustainable funds topped 20 billion in AUM. In 2011, SASB was formed with the goal of establishing industry-specific standards for corporate reporting on ESG issues and helping companies understand those metrics. So that's a pretty quick recap of what we've all seen and are aware of. Frank, if you could kind of go to that next slide. So this gets into sort of the very start of the topic for today, and implementing ESG into investment strategies. As indicated in our outline, ESG investing has been around for nearly 100 years. Given that fact, one would expect sort of different ways to implement and/or practices to emerge. Our friends at US SIF, this is from them actually, they've done a nice job of sort of summarizing the 5 different categories of implementing ESG into investment strategies and portfolios. At first, many of us were familiar with negative or an exclusionary screening. That includes, that's excluding certain industries or companies involved in activities deemed unacceptable or controversial. As I indicated earlier on the timeline, we now have what many have referred to as impact investing, investments made with intention to generate a measurable or beneficial social or environmental impact. That was also sort of the topic last year for our panel in October. The third theme that people have used is really sustainable themed investing, and those are investments that select assets specifically related to sustainability or single multi-theme strategies. In most cases, you will see sort of green funds, or maybe focused on environmental funds. The fourth way is sort of positive best-in-class screening. Investments in industries, companies, or projects selected for positive ESG performance relative to their peers. That'll be part of the topic that we discussed today. And the last one is closely related to sort of all of them. And it's really ESG integration, which is where many managers have gone to today. And it's investments that systematically and explicitly include ESG factors into financial analysis. So negative, positive, all of those kind of wrapped into one. The next slide is really sort of our first example of positive selection criteria. So as the world and the economy changes, so does the focus of investors. In 1975, I found that only 17% of assets in the S&P 500 were considered intangible. And in 2015, that number jumped to 84%, according to a study done by Ocean Tomo in 2015. A more recent report indicates that intangible assets are now estimated at 52% of a company's market value. And for some companies, the value can be as high as 90. Intangible assets span from patents or trademarks to goodwill, culture, or talent. Investors have paid attention to patents and trademarks, but now the focus is shifting to the other intangible assets. And as you can see on this this slide here, just a couple of headlines. As I mentioned, companies' intangible assets now can make up to 90% of their market value. There was also a report out by Raymond James, a research provider. Not surprising that using employee satisfaction rankings as a leading indicator of financial performance. And then below that, we have two examples of some technology companies, or loosely defined as technology companies. Technology companies have always generally been accepted as responsible investments in the sustainable space, mainly because of the lack of environmental concerns. And on this slide, we see two very good companies that by one research provider are considered low risk according to their research. Frank, if you can go to the next slide. This is, the use of positive selection criteria kind of has you dig a little bit deeper into these companies. And an area that we've focused on at Dana has been the corporate culture and the workplace environment that we define under the social category of the E, S, and G. Again, the same two companies who before were considered low risk, and two very good companies, yet we see one has a substantially stronger overall culture. And you see two screenshots here. One is from Glassdoor, which is really sort of a service where the employees themselves can take surveys and sort of comment on the workplace environment. That's a very useful source for us as we look at culture. The interesting thing there is it's generally it's anonymous, so they don't really have a fear of any sort of blowback from the corporation. And as you can see, you have the two companies again. And the highlight here is really looking at recommending a friend or approval of a CEO. You have one that's got very high ratings in those two categories and one that has very low ratings in those categories. Below that is another research provider that we use called Spring Pond Partners that has been, again, a advocate for positive selection criteria. And you'll see in that screenshot sort of a overall score, which is the overall cultural quality score. And that's sort of a starting point for us. As you can see, there's a significant difference in the two companies once again. One might lead or draw the conclusion that leadership, diversity, gender equality might lead to a stronger culture. And what does seem to be true is that happy employees lead to better productivity. I would encourage all of you at some point in time to pull up these two companies and look at their performance over the last 1 year or 18 months. One of the things that is very interesting about this is, as we talk about sustainability and we talk about positive selection criteria, while Ariane will focus and talk a little bit about sort of the more recent impacts on some different topics. These are generally long-term enhancements and performance indicators, and you'll see with this example quite a difference in leadership, kind of leading to what seems to be a much stronger and financially supportive company. So Frank, if you go to the next slide. You know, as I said, mine was kind of a brief history and sort of implementing strategies. As we talk about how to implement positive selection criteria, I know Ariane will talk more and more about this, and she'll have some great examples. But for those of you who are asset owners or consultants in the group, you know, the first way to kind of implement this is, you know, understand the selection of your investment manager or the strategy you've gone with. So we all know low-cost passive investment vehicles are out there that are exclusionary only, and those can fulfill a role in your portfolio. But if you want positive selection criteria, they're generally not going to do that. Understanding the research or the resources used by your partners, whether it's your consultant, your advisor, your manager, whatever that may be. Push those consultants or investment managers to provide portfolio analytics on their companies. Understanding that there is a plethora of information out there today that we have at our fingertips, and we should at the end really be able to be accountable and articulate a company's positive attributes to a end client, and then focus on investment stewardship. Again, just another way to sort of implement these positive selection criterias for your portfolio and avoid just the negative exclusionary realm. So with that, Chris, I think we'll pass it over.
I am waiting for the next slide.
Let me introduce you first, Ariane.
Oh, that's lovely. Thank you. Thank you, Chris.
So Ariane is with us. She is the Global Head of Asset Owner Strategy at Institutional Shareholder Services, otherwise known as ISS. She leads a global mandate to deepen ISS's relationship with asset owners and consultants across ISS. I'm sure many of you actually use ISS for a variety of different services. And so this is kind of her work is an expansion of what they've been doing for you in other areas. Before that, Ariane was head of ESG Strategy Americas and part of the leadership team establishing ISS ESG as the leader and gold standard in the responsible investment industry. Ariane joined ISS via, and I might mispronounce this, but Oicom Research.
You did very well.
I try. In May of 2016, having begun her banking career in Germany. She also has extensive experience with her own impact and ESG consulting businesses in Hong Kong and New York. And prior to that was managing director at Guggenheim Investment Advisors and served as senior vice president at David J. Green and Company, as well as several managing director roles at JP Morgan Chase, leading multidisciplinary teams. She serves on the board of directors of several nonprofits, focusing on social impact as well as ecological issues, including the U.S. board of the Climate Group. She is also an ambassador to TBLI, a Dutch-based organization dedicated to raising awareness about the benefits and opportunities of ESG and impact investing. We're really delighted that you've been able to take some time to be with us and talk about the role of asset owners in positive screens. Well, so with that, I'll pass it to you.
Thank you. And you know, it clearly shows, you know, once you get older, you know, there's just too many things that people, you know, can mention for you, which is sort of like, anyway, it is a great honor to be here today. I work across, you know, the different continents with a range of different asset owners. And I have to say that particularly the faith-based community is very dear to my heart. I think you really are the standard bearers in a lot of, you know, the stewardship push. And so thank you for having me here today. sort of thinking about, it was set up to sort of talk about the importance and really the power of positive selection criteria. And so I thought, and maybe we go to the next slide. I know they were rearranged a little bit, so I'll have to roll with the punches. I really thought, let's look at, some of the issues that the pandemic has laid that much more bare. And let's focus particularly on the social side. And from there, really highlight how important the positive aspects are. So if we're thinking, the kind of workforce restructuring that's happening during the pandemic, and, the amount of people that are likely going to be out of work. And if we're now thinking about, which are the industries that are worst hit, those also tend to have the worst union right records. So really important if you have a certain social mission, but also want to protect your financial returns is, from the data, and, there is so much more in terms of data available than there was 10 years ago, which is on one side great, on the other side can be a bit confusing. And I, second what John had said prior, it's really important to push your advisors on what resources they're using. But so getting back to this, so really important to confirm where the issues are, i.e. what are the industries that are likely going to see the most in terms of restructuring, i.e. where's the greatest hardship likely to happen. But then also to know, and can we go to the next slide? Then also to sort of look at who are the better players? So when we look at this chart here, it clearly shows that in those industries hardest hit, very few of them have good policies on employment security or treatment of responsible workforce restructuring. But then looking at those companies who actually do well, and you can see the light blue, those tend to be that are the best, either because they're in countries that enforce this or because they have established those kind of practices. And it's really not only are those companies likely going to do better on the whole because, a much more productive workforce, but they're also leading the charge for others to sort of see what's possible. So for you as an investor to know who are the best players, making sure you have exposure to them, understand what they're doing, and to the degree that you engage on this topic, use that knowledge with those companies who don't do as well, and really showing them best practices, really important. Next slide, please. The other side also is this pandemic really, has stressed companies on their labor practices. And this is where sort of the controversies come in. However, if we look at where controversies are and look at the percentages of companies that have been actually rather responsive to addressing those controversies and suggesting changes, be that around health and safety, be that around favorable working conditions, or union rights, we've really seen an uptick on commitment here. Again, really important for investors that care about this, to support those companies that have been, taking the pandemic and taking the controversies that have faced, that sort of have stumbled, and that are really now trying to change their practices and to support that. So really important to know. Another example, and this is a little bit older here, the data, next slide, please. Is to look at diversity. And here, this is more gender diversity in the media industry. And the message I want to get across here, and I'll lead you through the different graphs, is it's important not to stop at the first relative positive signal, but really to peel the onion a bit more. It goes back to the example John had earlier, don't just stop at sort of the first indication, but in his case, the question of riskiness, but really peel the onion a bit further. So it is known, and that's the top left chart, it is known that the female representation on the executive management level with media companies is not very high. However, and now we go to the chart below on the lower left, when you look at non-discrimination policies, media companies, relatively speaking, it's not great performance, but relatively speaking, perform well. However, it would be too soon to just stop there and look at this and say, okay, this is positive, let's look at this well. You really, to make the effectiveness happen, you need to also look at the measures to promote equal opportunity diversity. It's nice to have a policy, but then what are the measures companies are implementing to make sure this is actually happening, that it's not just written in some kind of employee manual and nobody looks at it. And that's where you really can see sort of the dark blue. Those are companies that are excellent. So within the media industry, there are only 14% that are doing excellent on that part. And then to the further left in the sort of lightest blue, I would call that, 9% who are doing good, whereby nearly half of them, and that's the other blue, are poor. So really important to understand that, know that there is this many more data available. So if I care about gender diversity and I want to look at different industries and see who has a poor track record, let me now understand who's really having a good track record, because those are the ones likely doing better, and they can be, again, you know, the ones who show the way how to do better, whether you use it from an investment point or you use that knowledge on the engagement side. Really helpful. Next slide, please. You know, and clearly the topic during this, you know, the last couple of months, there has been a lot more attention being paid to racial and ethnic diversity, and around with that, racial justice. A super important topic, and I know that many of you have signed, you know, the investor statement under As You Sow, and you know, with that understanding that one really needs to look at the power of the different data that can be available. I just want to talk to this rather than have fancy charts here. So what's available, or what can be available? Well, clearly you first want to look at what's the ethnic diversity at the board level. The companies are not necessarily disclosing that. ISS actually is one of the only ones who has that kind of data. We've done it on an assessed ethnicity data, sort of assessed basis, going back, I want to say, I think it goes back to 2012, so you actually have history. And we are also reaching out to companies to confirm that, and we're pushing companies to disclose much more of that, because you really start at the board level and you want to see that you have the diversity there, not just gender diversity, but also really the ethnicity diversity. But then from there, you also want to look at what are the company's practices with regard to their own employees and also their suppliers. Those data are hard to come by because generally what will be disclosed is more overall diversity, but that's a good starting point. And that's the kind of questions one can also ask companies as to what are the practices they start now employing, particularly as we've seen such stronger push with Black Lives Matter. So we expect that there will become more disclosure from companies, which will be good. So more data, which will allow to much more fine tune around this. And then one can clearly also look at the company's customer practices. This is a little bit industry specific, but whether that is a question of, you know, on the pharmaceutical side, you know, making essential medicines available, you know, there's a whole range of stuff. Again, one needs to really parse through the reporting of companies, and one needs to push for more disclosure. But it's this kind of information that really allows, if one wants to, as an investor, say, I'm supporting, you know, more better ethnic diversity. You know, what am I demanding of the companies? What am I demanding of my managers that they're looking for in favoring companies or on the engagement or voting side to really push companies to change. I think that particularly asset owners have a really important role here to play at this stage in time, where companies are much more aware that this is becoming a big issue for their broader stakeholder base. So that's their employees, it's their suppliers, as well as their customers. You know, that now also investors are really looking at this and demanding more proactive implementations from companies. So again, the positive selection criteria, a very important tool to promote more of this. I was also asked, we're switching gears now a little bit. I was also asked to talk about, you know, what's the proof? You know, we do this, we know companies are starting to do better on certain topics, and that's great. And, you know, that's super, super important because we want to improve sort of this, you know, the overall well-being of humanity. But what does it mean for financial return? Well, you know, fortunately with more data, there's more data also available on this. And, you know, this is part of a bigger white paper where I pulled some of the charts, and we're happy to make that white paper available to you. But I want to stick here more to the high level. And what we're looking at here, when you sort of see these bar graphs, 1, 2, 3, 4, 5, we've taken the universe of companies we research, which is a worldwide universe, and look at, you know, put them into quintiles. Number 1 being the highest performing from an overall ESG performance. So that includes everything, that includes, you know, the whole structure of the company, to 5 being the worst performing quintile. And what you can see on the left chart, whether you look at this by EVA margin, and this would be another half hour going through that, but it's explained in the paper, or you're just looking at sort of overall performance, the first and second quintile, i.e. the top performing the top ESG performing companies are doing better in terms of profitability and in terms of performance than the lower ranked ones. The other side of it is volatility. I mean, we'd like to have companies be profitable. We want to have higher performance. And ideally, we would like to have less volatility getting there. And same again, we can see a same kind of, you know, the top quintile has a lower volatility than sort of the higher quintiles. Next slide, please. And we can look at this, you know, I talked about the performance, and I'm sorry, I tried to put lots of graphs into little space, so I apologize straining your eyesight here. And so I try to keep it high level. If we're looking at the figure on the lower right-hand side, again, you have the 5 quintiles. And if you just look at that black line, that's basically, you know, it gives you the idea of lower asset, a lower return. So you get to the performance slide there. Again, lots of explanatory text underneath it. And I think particularly for this audience, and now I turn to the upper chart, it's important to know that high ranking ESG firms are just good stewards, good allocators of capital. And it really means that they're using capital as a scarce resource, which allows them really to drive up their return on invested capital. They're really looking much more at employee productivity, understanding that that's, you know, you have to have happy employees to have them productive. And if you have productive and happy employees, revenues will be higher. You know, you tend to lower your cost. And again, it drives up earnings. And we're seeing that really show up in the numbers. We can also look, and John referred to the importance of intangibles and goodwill. the sort of graph with the blue and black bars, the blue being sort of intangible assets as a percentage, and the black being goodwill, you can see that higher rated ESG performers tend to have the higher intangible value and the higher goodwill. Again, one can look at this and say, you know, they're not using as much money on capital expenditure. They're really using capital more for research and development. They're really being the innovators. And, you know, again, this is not happening on a, you know, from 1 month to the next. These tend to be longer term trends. But they really tend to, with that, ultimately be the winners and be the higher performers. Again, happy to share this rather dense white paper, but this is, and we did the study over a 6-year period, so starting from beginning of 2014 through 2019, well, 5-year period. We have other studies that really go back 13 years that just look at the universe of best performing companies on an ESG level comparing to the MSCI ACWI. And you see in each year there is a slight outperformance. So if you just did an index based on that, you know, you'd already have outperformance without even having, you know, smart portfolio managers add a little bit more to that. So I think we can really put paid to the question of, you know, doing the right thing is not good for the bottom line. Next slide, please. Just as, and I get animation. Oh yes, I get lots of animation. So we're talking about implementation, and I think the two messages here I have, and I'm really mirroring what John already said, is first, know what you own, know what your managers are doing. And I had some nice colorful slides on ISS's fund rating. And I think this here, just the first slide was just giving an overview, knowing, you know, how a portfolio is doing on a norms-based, from a norms point of view, how it's doing from an overall ESG rating, that is this one, to really see what's in there. Yes, next one. I love the animation. Many thanks, please, for this. Yeah, then here from a norms-based side to really narrow in what are the things that you care about. Next one, please. Or, you know, from an impact point of view, you know, how is a portfolio doing vis-a-vis the different SDGs, and where does it show positive impact vis-a-vis a benchmark? It also gives you information on voting analytics, how the overall portfolio has been doing on voting record. I mean, after all, we're ISS, so we care about voting. And, you know, whether it's done on a fund basis or it's, you know, done on a portfolio level, if it's an SMA, you know, and it's through portfolio analytics, these tools are out there, and your managers, you know, should, you know, provide you with that so that you have a sense, not only how is your company, how is your portfolio set up from, let's say, you know, a sector basis, but also from an ESG point. So you can really then have a meaningful conversation and sort of say, what are the things that you and your constituent care about? And, you know, how are they being addressed in the portfolio? Or if there are some really bad performers in the portfolio, 2 words, certain measures you care about. Now one can address and say, okay, let us have a discussion around this. Why are these names in there? What are some alternatives? You know, how do we improve not only, you know, sort of overall the portfolio, but how do we improve certain ESG criteria of the portfolio so it's more aligned with what we believe or what we care for? Coming back to the question of, you know, racial diversity, ethnic diversity, you know, are we seeing some improvements in that? And, you know, what are the measures that, you know, the manager can show us? At minimum, you can pull up, you know, board diversity. Is that improving or not across the board? And from there, the trickle-down effect. So that's, I think, from the asset owner's perspective, you want to know what you own, and you want to have your managers, your consultants, show you what is it that you own so that you can actually have a targeted conversation. Next slide. I'm not sure whether what happened now. Oh, yeah, you did it this way. Okay, we didn't need that. So we can go back to the nice pictures. On the other side, and let's just be very clear. What are the tools that the managers today have at their disposal? I think I've given you a little bit of a sense of the array of data that's out there. Whether it is from a controversy point of view, whether it is bad performance or whether it is good performance, and the ability to really peel several layers below sort of the top layer of something to really get at, how is a company doing at that? And then obviously that gets multiplied across the portfolio. So if a manager today tells you that they can't get the information that you would like to get, have them call us. The information is out there. And as John will say, John is, his firm is using different resources. Sometimes one provider can't give you everything and you need to supplement, particularly on the social side. There are often sort of detail layers that only very specialized providers might have. That's fine. But again, the information is out there, and sometimes in partnership, you may actually have resources where you say, on certain social metrics, you really like certain nonprofits as to what they're gathering. Well, bring them together with your manager so the manager can start implementing that information as well. All right. I've given you a lot of different information. Exactly. I love that slide. I hope we have some questions. You're on mute, Chris.
There we go. Frank had me muted there momentarily, so.
Little challenge.
Yeah, and maybe to put some of this in context as well for our members, we've been speaking a lot from the US SIF roadmaps, both for asset owners, for asset managers, and asset advisors. And especially from the asset owners roadmap, a lot of what we've been talking about today in those 10 steps, this touches especially upon number 3, identifying sources of ESG data, research and training, developing an ESG incorporation strategy, and like in 6, where it's talking about selecting managers for externally managed assets, so that what we try and do with these webinars with our members is kind of enhance the work we're doing in these different areas. And so this is really helpful around steps that we haven't spent a lot of time focusing on with our members. I'll open the floor first and just ask if any of the members have questions that they would like to share with John or Ariane. Feel free to unmute yourself and speak up if you'd like.
You usually don't have a shy group.
Maybe let me ask a question of the group. What is, as you're thinking of having more influence on your portfolios, what's most on your mind right now? Or what is a real stumbling block today for you? Let's go from that side.
I might take a first stab and then allow members, for instance, to speak a bit more to this. One of the historical things for many of our members is that they may have an engagement portfolio that our members use, and then the rest of the pot is administered by a different committee inside the religious order or the like. Mm-hmm. And so that the engagement portfolio, many of our members have a great deal of authority over. And then at least with some of our members, there's been a concern that they've only been using negative screens on everything else. And trying to move their institutions to use some of this new array of data that's now available and some of these new strategies that have emerged over time. does that, for some of our members, can you speak to if you want to unmute yourselves, speak to if that reflects where you are, some nuanced differences on where you are on these things?
You know, Chris, I'm not going to cut anybody off, but I just wanted to say that's pretty much the catalyst for this idea was a conversation where I think it might have been Sister Reg, who had said she sort of had her back pocket stocks, which were the engagement stocks, and then they had everything else. And that's really what got me thinking about this. So it's a good question.
Sister Reg is here.
I did notice that.
Yeah, if you want to ask a question, you can unmute yourself. I might start out with a question, and for John, as you say, there's a lot of ESG data out there now, John. Sometimes I see the data conflicting each other. So some companies are ranked very highly on certain platforms, on certain data providers, and that same company is ranked low or poorly on other providers. So I can imagine for a asset owner, it's very difficult to make heads or tails. You mentioned in your slides Sustainalytics, Glassdoor, Spring Pond Partners, of course,
ISS.
ISS.
Say,
Ariane mentioned made a strong case for ISS research. Bloomberg is out there. So it's difficult, I would imagine, for an asset owner to try to make heads or tails of sometimes conflicting and inconsistent data.
Yep.
How do they, and you say it's key to rely on your consultants and your money managers, but how does an owner know that their consultant is looking at the right things or putting enough emphasis on this? Ariane makes a strong case for financial performance correlated with ESG performance, but some of the more traditional money managers and consultants, I dare say, pay lip service to this, but don't follow through. So how does that asset manager know what questions to ask, I guess?
And may I do just one clarifying point in there? Because Frank, you said, different, lots of data and, different sort of assessments. I think there's the data are not so much in question. It is, and, that we can, disagree on some of this part. It is the question of how do you look at the world? Which data do you choose? What questions do you ask? And I'm talking about the ESG providers. And then what do you assess as material and what weight do you give it to? And I think that leads in, and then I'll let John answer it because that's where it should be. But I think a lot depends on knowing how the provider approaches the question and what their methodology is, and see whether that aligns with your own philosophy so that you know that the output you're getting, where it comes from. But now let me hand it over to John. I just needed to clarify this one part.
No, and you used a term there that I think will help answer sort of Frank's question too. You talked about materiality factors, right? And I mentioned in the history, you talk about, I talked a little bit about SASB, and as SASB becomes sort of, there's a key, I think, in what I've done some work more recently where I've paid attention to a lot of what they're doing and a lot of what they're talking about, but they're attempting to make let's say a level playing field, and they're attempting to help companies understand ways to report. And while Ariane's correct, I don't think the data is ever really in question. It's really about the end company and how they're focused on the data, right? Now, there are, in some cases, smaller sized companies, still publicly traded companies, but smaller mid-cap companies. A lot of this data, and in some cases, a lot of this data is coming from surveys and or company filings and things like that. And so SASB will help them sort of baseline and come up with better ways to respond or better materiality factors to focus on in their reporting. But then on the survey standpoint, you know, one of the comments you hear sort of from those smaller to mid-cap companies is they don't necessarily have that group there to help answer those questions. And so that's where I believe, you know, from an asset owner standpoint, it's a very difficult task, right? To kind of gather all this information and decipher it and come up with, you know, sort of the conclusion. If anything, that's a great plug for why you want, you know, a professional manager helping you with what you're doing, is because we have staffs to do things like that. The other thing I would say, Frank, in the question of the asset owner, and we touched a little bit on it, and Ariane touched a little bit on it, specifically about, you know, asking them the questions about what they're using and having that conversation with them. I'll be the first to admit, you know, I think it's, you'll find out pretty quickly those that develop a true passion for this, right? And they truly do believe it in those questions. You know, those who are kind of, those managers or those firms that are really almost chomping at the bit to have these conversations and have those explanations are really sort of the ones that have given it a good thought. I mean, we as a firm and as a team, we know there's days where maybe a name that's in a portfolio somebody doesn't necessarily agree with because they have a different, you know, sort of focus, but we're willing to walk you through sort of our thought process on it and, you know, help you understand why it was important to us or what issues were maybe important to us in determining that company as acceptable. So Frank, you know, at the end of the day, I think SASB is going to help the more and more that it's integrated into sort of the general business culture. I think as more and more research providers are out there in the world, that'll help sort of kind of provide a baseline. But then at the end of the day, the most important thing is for the client or the end asset owner to really define what it is that they want to focus on and bring those questions to the table to whether your consultant or manager is helping. So, Ariane, I don't know if you've got some.
No, I would agree. I would agree.
Maybe just to dovetail on that, John, I was at a meeting in New York with one of the ICCR events. I happened to go to a side event where Rob Jackson, the former SEC commissioner, was present. And one of the things he was saying to the people in the room with me was that the commissioners at the SEC, when they ask for disclosures from companies, really need to know what's helpful from what will help investors. You know, sometimes it's a cart and horse kind of question about which comes first. But the clearer we can be as investors asking for certain information. And so the more clear we are as an organization and our members are in asking of their advisors, asking of their managers, the kinds of things that we really care about. And so the Black Lives Matter movement, as well as COVID-19, actually affords us an opportunity as well of raising the stakes around certain questions around the workforce. Ariane was earlier saying, for instance, how those organizations that don't have strong unions are some of the ones that have been more heavily impacted with COVID. And so all these kinds of things, the engagement that we have both as investors with the companies, but also as investors with your advisors, your managers, begins to shape the data that's out there and influence what is most important.
And the one thing, and I'm sure that I'm, you know, walking through open doors here, but even if there is on one side and the engagement stocks and then the rest of the portfolio, you know, align the voting practices on the rest of the portfolio with what you're doing on the engagement stocks.
I have a question. This is Dan Trado from Milwaukee. The question for Ariane relates to ISS support of some of our shareholder resolutions. And we can tell when we have institutional support because our percentages go from 3 or 5% to 15 or 20. So how do we best align, and what is the criteria, I guess, that ISS supports or doesn't certain shareholder resolutions?
So that really starts with, so ISS is really facilitating, you know, we're bringing to bear the research based on how we understand market constituents think. So our benchmark policy, which tends to be the broadest tent, for which annually we do extensive investor surveys to really hear what's on investors' mind, to then aggregate that. So that means in the benchmark policy over time, we've moved much more towards supporting diversity, you know, things that are just really, as you would say today now, in investor mainstream discussions. We also have thematic policies that align more with specific interest groups. So we have a you know, faith-based policy. We have a labor union, we have sort of a Taft-Hartley policy. We have a public fund policy. They will take a sustainability or a climate policy. They will take slightly different views on specific topics that underline. So for example, in climate change, on the climate policy, where in the benchmark policy, we may support a management proposal, we may oppose it under the climate policy, just because, again, the directive that we're being given by the policy is slightly different. So we weigh these different elements in order to give to frame properly what is the mandate, and under that provide the research and then the recommendation. Now, to answer your question, how can you move more towards the areas that you care about? Make sure that, you know, everybody connected to ISS or who is receiving these surveys, which is not just clients, responds to those surveys, and hopefully if they respond in line with some of the things that are important to you, that is the feedback that we collectively get. It is a democratic process, so we need the votes.
Thank you.
Well, maybe we can move to the next slide, Frank, and one more. I just want to point out on our 7th generation website, our resources page. So across the top of it, you can see where the resources, if you click that, you'll find a number of tools that help evaluate the portfolios that a person has. Maybe we'll leave it at that for the moment. One of the things we point toward as well is that As You Sow now has a series of ways to evaluate mutual funds for different kinds of concerns. As you can see, there are 7 of them listed here right now. Fossil-free funds, so you can type in the code or the name of a mutual fund. It'll tell you what percentage of that is in fossil fuels. Or you might look at gender equality, and it will rate a mutual fund on diversity, about the presence of women, for instance, on board and leadership. Tobacco-free funds will assess how much is invested in different kinds of tobacco. Gun-free funds, deforestation-free funds, weapon-free funds, and prison-free funds. And it will assign a letter grade to many of those. And you might imagine that a lot of them are with very low grades. But it gives you just a very basic, simple tool for kind of screening and seeing where mutual funds are.
Chris, can I also say it gives you a great opportunity to then approach that individual, whether it's a manager or consultant, and ask questions about it. Because just like I showed and Ariane talked about digging a little deeper, that's the first level of sort of research. And it's really helpful then to kind of go from there. So.
And also please remember, there are no stupid questions. And I think you will find out with the more your manager is willing to work with you, the more you're probably in the right place. Because this is not ready-made. This is a journey. And, you know, ultimately it's the asset owners who need to keep pushing, and we applaud you for that. But you need to keep asking the questions. And, you know, when you feel stumped or confused, you know, reach out to John. You certainly can reach out to me, you know, or other resources. You're doing the right thing. This is, you know, this is not perfection on day one, but there is so much more information available that can be serving what you're trying to do.
Thank you, Ariane. Thank you, John. As you know, I'll be sending out then after this an evaluation of this webinar. We really appreciate your feedback. We'll also be making available the recording and the slides. And as you can see on the screen, we have email addresses for both Ariane and John. And we give our most sincere thanks to you both for your time and your presence with us and helping deepen our understanding and awareness and knowledge in the area of positive screens.
I don't need to get the last word in, but I really want to say thank you to Ariane for helping with this. And also, maybe if you've looked through, there's a gentleman who is Ariane's colleague, Matt Franklin, who was instrumental in connecting us. As always, I appreciate everybody's time. So,
thank you for having us.
Well, with that we conclude then. Thank you.
Thank you so much.
thank you. Thanks, Chris.
Bye-bye.
Thanks, Frank.